S&P 500 index funds stand out as most popular investment options, renowned for their unbeatable combination of affordability, minimal turnover, and outstanding performance. Billionaire investor Warren Buffett, revered as the Oracle of Omaha, has built his vast wealth through investing in S&P 500 and ownership of numerous successful businesses. Despite market volatility, Buffett advocates for a steadfast strategy: consistently invest in a low-cost S&P 500 index fund. Keep purchasing it through the ups and downs, particularly during the downturns. The S&P 500 is the real deal when it comes to index. It showcases 500 of the top US publicly traded companies, giving special attention to market capitalization. Launched in 1957 by the credit rating agency Standard & Poor's, the S&P 500 index is the cornerstone of the financial world. While you can't invest directly in the S&P 500 itself because it's an index, you can invest in funds that mirror its performance. That's where ETFs or mutual funds come in handy, allowing investors to participate in the S&P 500's movements and potential gains. These various S&P 500 index funds will closely resemble each other in terms of performance and the stocks they hold. Investing in multiple S&P 500 tracking ETFs or mutual funds won't add up much diversity to your portfolio, so it's best to stick with one. However, it's important to note that some funds may allocate only a portion of their assets to the S&P 500. Therefore, it's crucial to understand how each fund is structured. Just because a fund includes S&P 500 in its name doesn't guarantee it solely tracks the S&P 500 index. Always double check its composition before investing. Now, as we know the S&P 500 and why it's preferred over the other indexes, let's jump into the list of top S&P 500 funds you must consider for investing. First, Vanguard. Here's the rundown for you, and I will share my personal favorite at the end. But first, let's explore the options, weighing their pros and cons. This one is widely renowned ETF, arguably one of the most popular worldwide, the Vanguard S&P 500 ETF or VOO. Now, you might be wondering why I consistently feature VOO over other options, especially those with potentially better pricing and lower expense ratios. The basis I often recommend VOO is its accessibility. You can purchase it on almost any investing platform, making it convenient for a broad range of investors. My goal is to provide content that's accessible to you, regardless of your specific investment platform. While there may be other excellent mutual funds out there, they might not be available on every platform. That's why VOO stands out to me. I'm personally heavily invested in VOO because of its reliability. Last year, it boasted a return of 26% with an expense ratio of 0.3% and a dividend yield of 1.43%. With assets under management totaling 980 billion, VOO has been around since September 7, 2010, and it remains one of my top choices, particularly from Vanguard. Next one on the list is SPY, which stands for the SPDR S&P 500 ETF Trust. Distinguished as an ETF rather than a mutual fund, SPY doesn't claim the title of the most economically priced S&P 500 ETF. Yet, it is the most liquid S&P 500 fund. Liquidity serves as a gauge for an ETF's tradability. With increased liquidity typically means reduced trading expenses. While long-term ETF investors might not be greatly concerned by trading costs, those inclined towards frequent ETF trading should prioritize high liquidity funds to reduce such expenses. If your strategy is simple to buy and hold for the long term, then certain details may not be as critical to you. SPY, for example, has an expense ratio of 0.9%. Despite this, its appealing remains strong, with a return of 26% last year. It offers a dividend yield of 1.42% and manages a hefty 481 billion in assets. SPY has been a go-to choice for investors seeking exposure to the S&P 500 ever since its inception in 1993. Next one on the list is IVV, the iShares Score S&P 500 ETF. This is a significant player in the investment world, ranking as the second largest ETF in the US in terms of of net assets, just behind SPY. IYY boasts an annual expense ratio of only 0.3%, meaning you will pay just 30 cents for every $100 invested. That's roughly a third of the annual cost of SPY, making it an attractive option for many investors. However, for those who actively trade, IYY may present some challenges. Its average daily volume sits at about 4.4 million shares over the last 3 months, which could impact trading dynamics. IYY may not match SPY's liquidity, but it still packs a punch with a solid 26% return in 2023. Its dividend yield sits at a respectable 1.47%, managing a hefty $414 billion in assets under management since its inception on year 2000. IYY offers investors SPY-like scale without the hefty expense ratio, making it a compelling choice for many. Moving on to the next option, we have SPLG, the SPDR Portfolio S&P 500 ETF. This gem stands out with the lowest expense ratio on our list so far, making it a cost-effective choice. Additionally, it boasts the lowest share price, making it accessible to investors who prefer a more affordable entry point. For those who don't have the option of fractional shares, SPLG presents a solid opportunity to invest in the S&P 500 without breaking the bank. With shares priced around $55, it offers a more budget-friendly alternative to VOO's $450 per share. This particular option boasts an impressively low expense ratio of 0.2%, making it a highly cost-effective choice for investors. With a solid return of 26% last year and a dividend yield of 1.4%, it offers attractive potential for growth and income. It manages substantial net assets totaling $27 billion since its inception on 2005. Now, you might be wondering why SPDR offers two S&P 500 funds that essentially track the same index but differ in expense ratios. The answer lies in providing investors with options that align with their preferences, particularly in terms of cost. This strategic move mirrors similar strategies employed by Invesco, such as offering both QQQ and the recently introduced QQQM, which catered to investors' cost considerations while investing in the same underlying assets. Moving along, the next one on our list is a mutual fund, namely the Vanguard 500 Index Fund Admiral Shares, known by its ticker symbol VFIAX. Vanguard, esteemed as the pioneer of index funds, retains its premier position with the highest assets under management, boasting approximately $980 billion in net assets. Sporting an expense ratio of a mere 0.04%, Vanguard's VFIAX sets a remarkable standard for cost effectiveness. In 2023, the Vanguard 500 Index Fund Admiral Shares delivered an impressive return of 26%, despite requiring a minimal investment of $3,000. Its inception dating back to year 2000 underscores its enduring legacy. Anything associated with Vanguard epitomizes reliability marked by exceedingly low fees. Given Vanguard's towering stature and robust financial standing, entrusting your investments to its care provides a solid sense of security and stability. Next in line is a mutual fund hailing from Charles Schwab, known as the Schwab S&P 500 Index Fund, identified by its ticker symbol SWPPX. This fund is purposely designed to mirror the comprehensive returns of the S&P 500 index. Schwab's S&P 500 Index Fund typically allocates a minimum of 80% of its net assets to stocks within the index, although the actual percentage often surpasses this threshold. Striving for fidelity to the index's performance, the fund endeavors to replicate stock weights in alignment with those dictated by the index. This mutual fund offers a distinct advantage in terms of affordability compared to Vanguard, with an impressively low expense ratio of just 0.2%. Despite this lower cost, it doesn't compromise on performance, boasting a return of 26% in 2023, with assets under management totaling $82 billion. This fund signifies substantial investor trust and confidence. Moreover, its accessibility is noteworthy, as it doesn't impose a minimum investment required. Established since 1997, this fund from Charles Schwab stands as a testament to its enduring reliability and accessibility. Next one is Fidelity 500 Index Fund, represented by the ticker FXAIX, is a consistent favorite among investors, and for a good reason. Renowned for its steadfast performance, this fund stands out for its exceptionally low fees, with an expense ratio of just 0.15%. Its 2023 return of 26% surpasses that of its peers, making it a top performer in the mutual fund landscape. Fidelity's expensive assets totaling $472 billion showcase the trust placed in the company by investors. Notably, this fund doesn't impose a minimum investment requirement improvement its accessibility to a wide range of investors. Having been in operation since 1988, the Fidelity 500 Index Fund boasts a rich history of delivering consistent returns and exemplifying reliability. Now, which one of the above options stands out? Well, each option on the list offers its own strength, making them all solid choices for your portfolio. Given your investment with Charles Schwab, SWPPX shines with its low fees and reliable returns. However, if we look at the big picture, VOO steals the spotlight as my top pick. It's massive, dependable, has incredibly low fees, and you can easily access it through various investing platforms. Whether you lean towards SWPPX or VOO, both promise strong potential for growth and stability in your investments. So that's all for today. I hope you learned something out of today's video. If you did, then don't forget to like and share this video. Also subscribe to this channel. We share highly researched and informative content on our platform. We hope to see you in the next one.